Think you're a smart investor? Think again. Studies show that a shocking number of U.S. investors, over half in fact, are actively sabotaging their own financial futures and they don't even know it. From panic selling during a market dip to completely ignoring the taxman, these common mistakes are silently eating away at your wealth. The real question is, are you making them? Let's find out. Today, we're counting down the 8 biggest mistakes investors make and, more importantly, exactly how to avoid them so you can build real, lasting wealth. Coming in at number 8 is the classic blunder, panic selling. The market goes down. It's a normal part of the cycle. But that red arrow on your screen can be terrifying, and the urge to sell everything and cut your losses is powerful. Here's the hard truth. Selling in fear is the fastest way to lock in your losses and guarantee you miss the rebound. Studies show that even overconfident investors are prone to panic selling during downturns. The truly smart investors? They hold on. They have a plan. Some even see a downturn as a buying opportunity, adding to their positions at a discount. Always remember this mantra: time in the market beats timing the market. Don't let a moment of fear derail years of financial progress. That leads us directly to mistake number 7, trying to time the market. It's the ultimate investor fantasy, right? Buy at the absolute bottom, sell at the absolute peak, and become a millionaire overnight. It sounds so simple, but the reality is, it's nearly impossible. Even seasoned professionals with teams of analysts and supercomputers fail to time the market consistently. For every person who gets it right once, there are thousands who get it wrong over and over again, losing money with each attempt. Research from major brokerages like Schwab has shown that the cost of sitting on the sidelines, waiting for that perfect moment to invest, is almost always greater than the benefit of even perfect timing. Instead of trying to be a fortune teller, focus on a consistent investing plan. Dollar cost averaging, where you invest a fixed amount regularly, is a proven strategy that beats wild guessing almost every single time. Alright, let's talk about mistake number 6, overtrading. In our hyper-connected world, it's tempting to constantly tinker with your portfolio. A hot stock is trending on social media, and new ETF promises to be the next big thing, and before you know it, you're buying and selling every other day. This constant shuffling, known as overtrading, can absolutely wreck your returns. First, you have trading fees that can add up quickly. But the real killer is taxes. Every time you sell an asset for a profit, you create a taxable event. Research shows that even a small portfolio turnover of just 5% can reduce your after-tax returns by nearly 3/4 of a percentage point. That's huge. The solution? Stop chasing shiny objects. Create a solid, long-term plan and let it work for you. Less is often so much more when it comes to investing. At number 5, we have a mistake that can cost you dearly: ignoring taxes. You've worked hard, made some smart investments, and your portfolio is growing. Fantastic! But have you thought about what you owe Uncle Sam? Many investors don't, and they get a nasty surprise come tax season. Capital gains, dividends, and yes, even crypto profits are all subject to taxes. If you're not prepared, a significant chunk of your hard-earned gains can vanish. The good news is that you can be strategic about it. Take advantage of tax-advantaged accounts like a 401k or a Roth IRA. Understand the difference between short-term and long-term capital gains, as long-term gains are taxed at a much lower rate. A little bit of tax planning can save you thousands of dollars, so don't let the government be an unexpected partner in your portfolio. Next up, mistake number 4, failing to diversify. You've heard the old saying, don't put all your eggs in one basket, and in investing, it's gospel. Yet, so many people do it. They fall in love with one company or one industry and pour all their money into it. This is incredibly risky. If that one stock or sector takes a nosedive, your entire portfolio goes down with it. Diversification is your primary defense against this kind of volatility. By spreading your investments across different asset classes like US stocks, international stocks, bonds, and maybe even real estate or commodities, you smooth out your returns. When one part of your portfolio is down, another part might be up, balancing things out. Fidelity's research confirms that a diversified approach helps manage risk while still allowing you to capture market growth over the long run. It's the key to sleeping well at night, no matter what the market is doing. Sliding into the number 3 spot is a silent portfolio killer, ignoring fees. This is one of the sneakiest mistakes because it happens in the background, slowly and quietly draining your wealth over time. We're talking about expense ratios in mutual funds and ETFs, trading commissions, and advisory fees. A 1% or 2% fee might not sound like a lot, but over an investment horizon of 20, 30, or 40 years, the difference is staggering. And now for mistake number 2, a psychological trap we're all susceptible to: following the herd. A particular stock suddenly becomes the talk of the town. It's all over the news, it's trending online, and everyone you know is buying it. The fear of missing out, or FOMO, kicks in, and you jump on the bandwagon without doing any of your own research. This is called herd mentality, and it often leads to disaster. As Forbes points out, the urge to stampede toward what's popular is natural, but it's rarely a productive investment strategy. By the time a stock is popular enough for everyone to be talking about it, the smart money has often already been made, and you might be buying in right at the peak, just before a crash. Instead of following the crowd, stick to your own well-researched strategy. Be a thoughtful investor, not a follower. And finally, we've arrived at the number 1 most critical mistake US investors make: having no plan. Investing without a plan is like setting sail across the ocean without a map or a compass. You'll just be drifting, pushed around by the winds of market volatility and the tides of media hype. A solid financial plan should outline your specific goals, your time horizon for each goal, and your personal risk tolerance. Are you saving for a down payment in 5 years? Or for retirement in 30? Can you stomach big market swings? Or do you prefer a more conservative approach? A recent survey found that only about 3 in 10 investors have a comprehensive financial plan. Having one is your anchor. It keeps you grounded during market storms and focused on your destination. Create a plan, stick to it, and only make adjustments when your life circumstances change, not because of short-term market noise. So there you have it, the 8 biggest mistakes that are holding investors back. Avoiding them isn't about being a genius or having a crystal ball. It's about building a foundation of strategy, patience, and discipline. Your future portfolio will thank you for it. Now I want to hear from you. Which of these mistakes do you think costs investors the most money? Let me know in the comments below. And if you found this helpful, be sure to hit that like button and subscribe for more smart investing tips to help you build your wealth. Thanks for watching.